Hi, friends. I am coming to you today because I overheard a conversation and I thought I should come on here to talk to you a little bit about what I overheard and what I think the perspective should be. And that conversation is around focusing on building your credit or building good financial habits. Now, I'm of the school of thought that if you build solid financial habits, your credit scores will follow. And here's what I mean by that. I'm going to share the breakdown of the FICO score and the breakdown of the Vantage score. The FICO score is as follows: 30%, 35% of on time payments. Yes, that is part of good money habit. 30% utilization, meaning how much of your credit are you using? Are you using all of it or less than maybe 10%? 15% of your FICO score is length of credit history. How long have you established credit? 10% credit mix and 10% credit inquiries. Now, as it relates to Vantage, it's 40% payment history, 21% age or type of credit, 20% utilization, 11% total balances, 5% new accounts, and 3% amount of debt. Now, what I'm saying is we don't need to focus to on growing our credit scores to the exclusion of building good financial habits. Those good financial habits include budgeting, however form that takes, because again, this is personal finance. So your budgeting form might not be the way I budget, but as long as you have some way to manage your money, to manage your cash flow, 82% of businesses fail because of poor cash flow. And that is based on a study by US Bank. So that tells me things like cash flow should be managed. That is not reflected in your credit scores. So if you're working on only building your credit scores and you're not practicing good budgeting skills, good cash flow skills, or cash flow management, then you might end up building your score by focusing on those components. But when an emergency comes, you don't have an emergency fund. You don't know what your cash flow is. You don't know how to manage your expenses so you can manage the utilization on your credit card. Setting financial goals is a good financial habit to have. And when we practice these things, setting financial goals and working those goals, that's going to help us curtail running up our credit cards. That is going to stop us or give us second thought in not paying our bills on time. And I'm not talking about when emergencies happen, like a medical emergency or something like that, that cause you to have to now not pay, you're not able to pay your bills. That's different. I'm talking in general management of your monies outside of those extreme emergencies. Once we practice good budgeting habits, good cash flow habits, building an emergency fund, setting financial goals outside of growing our credit, all those other things will follow. Because if we manage our cash flow, we will pay our bills on time because we'll know the ebbs and flows of our cash flow and we'll know what needs to be paid and when. So that will take care of itself. Utilization will take care of itself if we build an emergency fund, if we budget. All those things will take care of itself. So my encouragement to you would be not to focus so much on growing your credit, but to practice good money habits, good financial habits. And once you do that, your credit score will follow. And I can say that because I am a witness to that. I walked away from my house in 2015. My credit score dropped to in the 500s. Today, last time I checked, I was at 793, 803 FICO, 793 Vantage. So all I did was practice good financial habits, like having a budget, managing my cash flow, managing my assets, the purchasing of my assets, managing how much liabilities I have, managing my net worth, building an emergency fund, setting financial goals so I can be intentional. And once I did all of that, my credit score followed. So I hope that's helpful for someone. And until next time, this is Dr. Sev at Dr. Sev Talks Money.